So friends, thanks a lot for your time, enthusiasm, participation. Always help us to do more and more innovative subject. And today is a totally little different topic, pre-IPO, eligibility and compliances. So I don't know how people may be wondering what kind of this topic is there, but this topic is consciously selective. And I will like to just give you brief why it is this topic and one should be, you know, preparing themselves for IPO. It's like can compare that if we are playing cricket in our gully or mohalla, you are and we are there. Umpires also us. And many times in anger in childhood will say, whosoever stump is there, I will get first batting, otherwise I'll take stump and go or bat. And we used to run, and many times, even though we will play by rule, we have leisure approach. But the same player has to play and represent country and the public in public. They have to play in an international field or national level. Then it has a lot of rules, regulations, observance, and to handle himself or herself in a particular manner, even though you play properly. Same IPO. When we are private company, there is a totally different, your own money, your own people, your own management, you are whole and soul. It's your baby. You have thought of given the birth to this baby. But now when you are going for IPO, you are taking, involving everyone and telling this baby is now of everyone. Everyone is investing and everyone will want to share and everyone wants to play and exercise their right. At that time, first, mentally we have to prepare ourselves. This baby is not yours only, it's of public. That mental preparation of management is crucial. And then comes your own behavior, your compliances, your public representation, your diligence, integrity, how you exhibit your integrity, honesty, governance. And that's why this exercise is necessary. Otherwise, it creates a lot of problem and havoc for even a good company, a good player. And this is the reason I thought that, and Mehta, we specially have this kind of programs where we prepare the company management, we do presentation, and we ensure that the company is ready for IPO. And we do this 1.5 year before the IPO. And today, for a change, my senior partner Ashwini herself is giving presentation because these are pet topics. She is regular in this. She keeps on giving. And so this is my seasoned player only. So today I will introduce, and I think I don't need to intervene. She can play she is a sole player for today's match. And she can do, and of course our Bala as usual is always there. Thanks. Friends, today we have our good panelists who are experienced well as well. And we have with us Ms. Madhulika Rawat. Welcome, Madhulika. And
Thank you.
Mr. Sujoy Bose. Welcome, Sujoy.
Thank you.
Give brief introduction. Ms. Madhulika is having around 16 years of post-qualification of experience. She is currently working in restaurant brand Asia Limited and have worked in companies like Yes Bank, Adlabs Imagica, Reliance Media Work. For information, restaurant brand means earlier known as Burger King. She has handled 3 public issue, oh great, including 2 IPO and 1 FPO. And as regards Sujoy Bose, welcome Madhulika.
Thank you.
Sujoy Bose is the Company Secretary Compliance Officer of Indigo Paints Limited. He also heads legal division at Indigo Paints. He has over 7 years of experience in the field of corporate law, FEMA and other secretarial function. He has recently led the IPO process for Indigo Paints. Welcome Sujoy.
Thank you so
Thanks a
much.
lot for your times, and what I like you to share your experience and your views. So, friends, as usual, all participants, you can put your question in the chat box. Same will be taken care as and when the topic is going on. And both panelists, you can intervene as and when you want to say something when the topic is going on. I'll request Ms. Madhulika and then Mr. Sujoy to give your view on the topic, and then Mr. Bala for 2 minutes, and then Ashwini can start the presentation. Thank you.
Sure. Good
And
morning,
Mr.
everyone.
Bala don't need any introduction. He is now equally known to everyone. Thank you. Yeah, Ms.
Hi.
Madhulika.
Good morning, everyone. Thank you, Dipti, for such a great introduction. And I thank Mehta and Mehta team for inviting me for this topic. And this topic is definitely very close to me, considering, handling so many public issues. So it's I was very happy when Mehta and Mehta, contacted me to be a part of this discussion. Thank you so much. And I'm really happy to join and share my experience on the public issues which I've handled. And as you said very correctly, the example that you gave on cricket, it is a really apt example to be given on the topic. And see, IPO, initial public offer, it is a great milestone for any company. So that is kind of, once you do an IPO, lot of things, lot of avenues open up. So uh, overall, from the company secretary's profile point of view, also lot of governance point of view, etc., everything has to be taken care of. It is not only like we have finished the IPO, it is done. There are several other things to be taken care of. So broadly, when we do an IPO, what I believe, there are few aspects, especially one is process driven, which is from the regulatory point of view. Then there is one of the most important thing is marketing the IPO, in which mainly your CFO, investor relations head, and investment bankers are involved. Then how you price your IPO, the valuation which is done, and definitely the reason behind why you're doing an IPO. And most importantly, when you're doing an IPO, transparency is very important. More transparent you are, people will definitely trust you more, and then investors are definitely going to trust the company and invest more on your company. So overall, this is what my experience and my, in short, I can tell you about the IPO. And thank you so much. And going forward, looking forward for the presentation from Mehta and Mehta, and share my experience too.
Thank you,
Thank you.
Madhulika.
Yeah.
Thank you. Sujoy, please.
Thanks, Madhulika. First of all, I would like to thank the Mehta and Mehta team for inviting me for this session here. Looking forward for this. I would like to share that in the recent past only I've gone, I've had the company go public. One of the most, the challenging part in the IPO process is definitely to, work with the promoters who are running a private limited entity, to make them understand basically now, as Dipti ma'am rightly said, it's not your baby anymore. That is one of the challenges which I think every company secretary would face when you are taking a company public. But I think that's a part of the game. And when we are students in company secretary course, we are always, told that, IPO is one such milestone in every CSS career that one dreams to have. And I feel that young company secretaries who get this opportunity are very lucky at their early stage. Many things to learn, and the process teaches you many things which are not a part of your course. And I really urge all the company secretaries, the young company secretaries who will become CSS in future, to definitely, try getting this exposure, which maybe no one else can teach you rather than the process. I look forward to this session, and thank you so much.
Thanks, Sujoy. Mr. Bala, your view for 2 minutes.
Good morning to all of you. I have a great pleasure on my own behalf and also on behalf of the Mehta and Mehta to welcome all the participants for today's interesting session. I have our old timer, Mr. Shailesh Pai, who will agree with my view. Something closer to 3 decades ago, as Sujoy was telling, I had the opportunity of handling a public issue as back as somewhere in 90s. That time there was no what do you call an online portal. There was nothing like that and other thing and all. Everything is simply practical. Everything is simply paper based. You have to walk to the stock exchange. You have to get the principal approval. You have to do many things. Even stamp duty issue was the biggest issue there. People used to travel from one state to the other state and they issue the share certificate. We also did the same thing at that time. We traveled all the way from Bombay to Delhi and we appointed the share transfer agent. We stayed over Delhi and we issued. It is a massive, massive job of doing that. That time when we had experienced a lot of things as back as 3 decades ago. Today, the things have changed a great lot. Many things are online. At the same time, the compliance requirement, the stringent requirements, the things, procedural issues, it's all very, very complex. It is not that easy. But the only thing is meticulous planning, meticulous housework, meticulous homework is done. Then in case everything will go well. And as I've been always feeling, always telling, I actually feel something about 25 youngers when I interact with the younger people here. So today we have much younger people who have a experience of today's context. I will definitely have a benefit of hearing. I can actually witness myself what has been there, what is today, what is the sea change we can actually see, what is the meticulous efforts will be there. It will be a very good opportunity for the young aspiring company secretaries to know the better thing, especially to learn from the experienced people here. It is going to be a good learning to all of us. I look forward. Thanks a lot.
Thank you. Now, Ashwini, it's over to you. You can take on and I'll take leave. Ashwini, now I am giving reins in your hand. Carry on. Thanks.
Thank you, ma'am. Good morning, everyone, and thank you, Dipti madam, for the apt introduction regarding the IPO. Welcome, Madhulika and Sujoy. We are looking forward for your interaction during the session. As we rightly have stated, is what we started with this topic of pre-IPO and compliances and eligibility. So to understand what is an IPO, everybody knows what is an IPO. It is an initial public offering. But till date, you have to understand that the company was working in a very reserved or secured environment. It was working in a very private sector, like it had a lot smaller number of shareholders and investors to deal with. Now, the moment IPO comes into picture, there is a huge palette it has to address to. There are a lot of large number of investors that a company will have to cater to. And similarly, it will be its first public offer. So obviously till now there was only 1 or 2 regulators in picture. Now the securities market regulator will also come into picture, that is SEBI. So you also have to comply with the SEBI regulations in this regard. So basically IPO is initial public offering of securities of privately owned company. So to define this is that the moment you decide to go public, obviously a private company cannot maintain its stature. It has to get converted to a public company. Only then and then it can go ahead with an IPO. It is a mix of issuances, like it can be a fresh issue of entire new securities, or it can be a mix of new securities issuance and sale of existing shares, or it can be entirely sale of existing shares. So to give an example here is the entire existing shareholders exit was through an LIC IPO. A mix of both could be seen in Nykaa and Paytm. And Adani Wilmar came out with a fresh issuance of all the new securities. So this is how IPO is. We'll in the later slides discuss what are the requirements, what are the eligibility and everything. So let us move on to the next. So you can see in the life of a company, these are all the types of issues that a company has. IPO comes here wherein it is a kind of a public issue under the Companies Act. It is a fresh issue offered for sale. It can be a mix of both, as I discussed. So this is very important to understand that why would a company need an IPO? Why would a company go for an IPO? Basically, the first point is to raise capital for growth. IPO provides the company with access to raising a lot of money. So it can expand, it can raise the capital for its growth purposes. Though what is the requirement or why the company wants to grow or expand has to very clearly be explained in the DRHP or the prospectus that we call. Yeah, it is very clearly that you have to mention why you want to expand and what is your idea of a future thing when you receive the capital. Madhulika, would you like to say something on this raise capital?
Yeah, see, basically the objects of the issue, what we call it, there's a separate chapter itself in our prospectus. So here you have to be very, very particular on where and how much, and even the breakup as well, like if it is for expansion, like you have your first point as raise capital for growth. So if you have this for growth, so if I have a capital expenditure for my expansion, how will I utilize that funds as well? That also needs to be captured. For example, I'll tell you for restaurant brands Asia like Burger King India, one of our objects was for expansion of our business. So we have a certain plan like how our restaurants will be opened in the next few years. So and how much would be utilized in each of the years. That as well has to be covered. So that kind of a transparency is required on how you're going to utilize the funds so that the investors are aware they're investing for what and where this money is going to be utilized. And similarly, for many companies who come up with an IPO, they have existing debt in the company. So most of the IPOs would have this as a common object of repayment of debt or for the general corporate purposes. And there are several other reasons which Ashwini you can take through. There are for having a broad investor base and raising capital for several other purposes. So this is what mainly the objects generally contain for the company. And that is the intention, like, to give clarity where the money is going to be used.
Correct. Thank you. So basically, to raise capital for growth, then to raise profile and status in the market, obviously, by going public, you are going to do a lot of corporate governance practices you're going to follow. Though you were in the private sector, but now SEBI regulations and all come into picture, there is going to be a lot of transparency. It is always you are going to come in the public eye. So it is going to raise your profile and status in the market by going public. It will also help you to realize the value of your company. Then it also helps to obtain a broad investor base, then provide an exit strategy for existing shareholders. So here, if at the time of when you were a private or a public company, there were existing shareholders, then you can provide an exit strategy. We know a lot of agreements wherein the shareholder agreements wherein they provide the exit strategy at the time of IPO. So this is also another way to provide them an exit strategy. Another important aspect could be repayment of debt and financing working capital requirements. So now you've decided to go public, but you have to know whether you're eligible to go public or not. The regulations come from the regulations, SEBI regulations of issue of capital and disclosure requirements 2018. You have to refer to those regulations even if you're not listed. Those regulations become applicable to you prior to the listing. So in regulation 6 of ICDR, what we can see is there are a host of eligibility norms. And if you are conforming with those norms, you are eligible to go public. So regulation 6(1)(a) talks about net tangible assets. So it says that net tangible assets of at least rupees 3 crores for the preceding 3 full years, of which not more than 50% are monetary assets. So you have to draw your eligibility on the basis of these norms that are given in SEBI ICDR. Secondly, it also talks about the operating profit, your average operating profit of at least 15 crores in each of the preceding financial years. Then your net worth should be at least 1 crore in each of the preceding financial year. Accordingly, your revenue, in case there is a name change that has happened just prior to the listing, then at least 50% of the revenue should come from that new name. Now you understand that most of 1 to 4 may not be satisfied in certain kinds of IPOs. Basic example could be of Zomato, wherein it could not qualify for all the 4 transactions. So in that case, what it can do is, in case of non-satisfaction of the above conditions, it can go for book building process. So we'll talk about the book building process in the later slide. So issue shall be made through book building. 75% shall be offered to QIBs, and full money will be refunded if the company fails to do so. So these are the eligibility norms for making an IPO. So company has to comply with these norms to come out with an initial public offer. So now we assume that the company is falling under the criteria that is mentioned in Regulation 6, and it has decided to go ahead with the IPO. The first and foremost thing that the company will have to follow would be the due diligence process, because the due diligence is the very important part of a successful IPO. So what can be the major component of due diligence is it should be unbiased. It should be carried out by independent professionals. It requires management cooperation, and it has to have a problem-solving attitude. Sujoy, would you like to throw some light on this?
Yeah, thanks, Ashwini. So once you are appointed as a company secretary in a company which is going public, maybe before the independent professionals come in, you yourself can also start this activity. That would be helpful when this due diligence process by an external consultant is carried out, because you're already putting in place and bridging the gaps which are there in the company to go for a successful IPO. Second, for this due diligence process, I think in my personal experience, I feel that when your external consultant, instead of just highlighting the gaps to you, he or she comes up and says that, look, this is the gap and this is how we fill it. So that is what you have mentioned in your last slide. I mean, there it's called problem solving attitude. Companies will look for solutions. They will know the problems, but you will have to come ahead and give them the solution as to what is to be done. I think out of these four, the last aspect is very important, so that the company is also comfortable going ahead with this process. Thanks.
When you talk the problem solving attitude, the being a employee company secretary, it is a must for him to go through the memorandum article of association of the company. Because why I am saying this, although 30 years back I handled the IPO, the very first thing is I was just going through the OA of the company. Because it was closely held the public company with a foreign shareholding of about 50-50, 50 Indian partners, 50 foreign partners. So they had the arrangement, each term they will appoint their managing director, second term these people will appoint the manager. Now, one of the things which was there, clause contained in that articles was, none of the board meeting can be held without presence of the foreign nominated director. This was one of the conditions. When we go for the listing, this will not work. Because the problem is every quarter you need to have the board meeting. If we say unless that particular person is not available for the meeting, you cannot have the meeting. That way we will be end up in the compliances for the purpose of holding the meeting, we cannot do it. So very first and foremost thing, we have to get amended that articles in such a way that for a particular meeting, the overseas company or the director himself then give a permission. That meeting will be valid if he intimates his unavailability in beforehand. Then again, those days, since the technology was not so much, you may be knowing, those days it was only, what is some telex machine, and later on the fax machine, which was actually there. So in our article, we are included communication either telephonically or either letter or either telex or either fax or any other mode, whatever it is, that will hold good. That is the way we have amended before we went to the principal approval to be taken in the stock exchange. So really, as you rightly said, it is the company secretary who is there within the company, they himself can identify the problem. He can actually get rectified so that when the external agency is coming, it will be easier rather than wasting the much more time.
Thank you. So this we have discussed what would be the purpose of due diligence that a company would deal with. It is to assess the reasonableness of historical and projected earnings and cash flows. Another important thing is identify key vulnerabilities and risks and opportunities. So risk factors are understood from the due diligence process. Understanding the company and its market. Then setting in motion planning for post-IPO operations. Then highlighting the changes required in Companies Act, tax angle, legal, corporate structure or shareholding structures, and to check whether company has complied with all the laws till date. And if the company has not complied, then the same will form part of the risk factors in the prospectus.
Ashwini, Shailesh here.
Yes, sir.
Ashwini, would you also recommend carrying out a forensic financial audit of the company prior to the IPO? Why I'm saying this is because if there are some shortcomings in the accounts, if there is some fraud which is not known, we would like it to be known before and not after the IPO, because then it becomes a huge, huge embarrassment. I don't know whether the panel has any views on this. I'm talking about a forensic financial audit.
So there is a restatement of financial statements that happen before the IPO. So I think it should serve the purpose. Sujoy?
No.
I would also agree to Ashwini, like when the financials are restated and there are various certifications and confirmations given by the statutory auditors of the company, they have to give some comfort letters. A lot of things are already in place. So forensic audit, especially for the financial part, I don't think that is a necessity for any company to do. There are various checks and balances and the due diligence which is carried out by the merchant bankers as well as the international lawyers. I think it covers most of it. And even if you try to hide something, I think somewhere or the other, things come out.
I would agree with Madhulika on this, is that during the IPO process, you have so many intermediaries, checking all your books of accounts and your other documents. A specific forensic audit, maybe on a voluntary purpose, if the management is not sure whether they are doing the accounting properly.
I'm saying voluntary. I'm saying voluntary. I'm not saying imposed. Voluntary.
But, exactly, voluntary. It is management's call, but as a process or a requirement in the IPO, I don't think it is required, because when a company is planning for an IPO, I think their mindset is already, made 2, 3, or 4 years before they actually start the IPO process. So this cleaning up and everything, and the auditors become more diligent once they come to know that the management is planning for an IPO. So prima facie, even I am not of the opinion that a forensic audit should be required, but again, it's a management's call whether they are comfortable in doing that or not.
So in the restatement, obviously, this will come out if there has been any fraud and if that has not been stated. It might come out in that also.
Actually, usually a restatement, if I may just add to that, is mostly because what happens is most of the Indian companies are following the GAAP accounting standard. And when you're switching to Ind AS, basically, so most of the numbers for the last 3 years have to be restated. So that is actually the main purpose of restatement. But as you rightly said, while doing the restatement, auditors, in my experience, because we have a big four, they will go through each and every number and cross-check it with all your general ledger balances. So that due diligence is anyway done during that process.
Thank you. So next is need for the due diligence in IPO. The need is because it is going public and there will be an increase in the number of shareholders. Then a board performance will be subject to scrutiny post you become listed. Another thing is institutional investors look for better corporate governance practices, increase in share prices, achievement of profit targets and dividend payouts. Investors also look at reassurance of a system of strategic planning and budgeting, financial reporting, and management information. And the SEBI disclosure requirements are met through the due diligence process. What would be the key areas of focus in case of due diligence? First is, of course, the financial statements we've discussed. To ensure their accuracy is important. Then the assets, confirm their value, condition, existence, and legal title. Then who are the employees, their identification of the key managerial personnel and the senior management persons is important. What would be the sales strategy, analyzing the policies and procedures in place. What is the marketing strategy, what is driving the business and whether it is effective or not. then industry in which the company operates, understanding the trends and new technologies in that industry, then understanding what are the competition, the threats to that industry, then the systems, how efficient they are and what is, if any upgrades are required.
Ashwini, just want to add on to this. Can you come back to the last slide? Thanks. So the third point which you have mentioned is employees, right? So I think in a process, once you're a listed entity, before that, this becomes very important, because once you're a closely held company, the concept of KMPs and SMPs are usually not known to the management. I think as company secretaries, we are, it's our duty to make them understand what is the difference basically between a KMP and an SMP, and what are the liabilities which these designations would cover. Now, as we all know, KMPs are also defined in Companies Act, but then SEBI comes up with another definition of a senior management personnel who are equally liable for many activities in case something goes wrong in the company. So I think as company secretaries, we should sensitize our management regarding this aspect as well. Thanks.
Then the legal, corporate and tax issues, is the shareholding structure robust? Are there any tax issues which need to be addressed? The contracts and leases identify the risks and obligations. So the due diligence process, all these things are looked into, checked and reported accordingly. Further, suppliers, are they expected to remain around? This may happen if there is any change in statutory regulation or anything, and if that product suddenly becomes redundant, then there is no point in going ahead or something. So you need to see, you need to forecast that this product is going to remain in the long run, and accordingly, the due diligence process also will be checking that. Then intellectual property, if they have, and what, how, whether it is protected and to what extent. In the legal issues, obviously there is a legal counsel who will be doing the due diligence, will be checking the licenses and permissions the company has, the litigation, real estate and movable property, Companies Act, whether it is complied with, any employee consultants, labor relation, all those related matters, and environmental permissions if that company is in that certain sector. So all these matters will come out in the legal issues of a due diligence. This we have discussed. So this is the most important step, that is management activities that are required at the time of pre-IPO. So first and foremost, you have to see that there is an amendment done to the Articles of Association. If you are a private company, you have to get yourself converted to public company. If you have investor clauses, accordingly the amendment will happen. Sujoy, I just want to know, what if the foreign shareholders or foreign investors that they decide not to sell their shares in IPO? Does that happen?
So, I mean, usually in the previous 1 or 2 years, I have not seen this coming in. Usually, new tech companies are going public so that they give an exit to their existing shareholders, mostly the PE guys. But I'm not aware in the recent past where no PE investor has exited, divested at least some percentage of shares during the IPO and the OFS process.
So what happens to the investor clauses in the articles in that case?
So usually what happens is, till the DRHP is filed, the clauses remain as it is, and there's an understanding between the company and the shareholders, which is there in an agreement saying that once the company files the RHP, that is the next document after DRHP, all your special rights, as they call it, in the articles will drop off, and it will become the normal articles as required by the Act.
So they will not have any separate rights?
No, they will not have any separate. One right which I've seen in many companies, they still, pertain, and it is allowed by SEBI also, is that post-listing also till a certain percentage of shareholding of that investor, they will have the right to nominate one director on board.
Can I just add something on the amendment of articles? See, for example, I'll talk about the company. We have PE foreign shareholders. So in our case, normally before listing, we have two sets of articles, Part A, Part B. So Part A is normal articles of the company. Part B is generally containing all the terms and conditions of the investment which was done by the PE before we go public. And it is always like, once you go public on IPO or on listing, the conditions are given like that. On listing, this articles will not be valid. So hence, most of the things are that Part B completely goes off once you get listed. But as Sujoy rightly said, there are few clauses in your articles in the Part A, for example, the main articles of the company relating to the percentage of the shareholding that they hold. They contain some of the rights of the number of directors that they will appoint, or for quorum purposes, one of the director for each of the committees, it is mandatory. Those clauses, but that also immediately post listing, it is like not effective. To get that particular clause effective, the ratification from the shareholders is required. Unless and until the shareholders post listing approve that in the articles, basically called as the ratification of those clauses are not effective, and they cannot exercise that right till the time it is ratified by the shareholders post listing. So this is very, very important, and where I'll share personal experience as well. Getting these clauses ratified itself is very, very difficult. It is mostly institutional shareholders are not comfortable giving this right to the existing promoters. So there a lot of different views are there from the company to company, and it is very, very important to handle the new institutional investors in this case.
So amendment to articles is required, as she has rightly put in. Second is demat of shares. Company has to ensure that their entire holding is in demat before going public. Then the issue structure is to be decided. What would be the reservations for employees? So all these criteria come out of the SEBI ICDR regulations, which mention what could be the reservation for employees. I think it is a maximum of 5% of post-issue capital. Then pre-IPO, if there was any ESOP policy in place, then what would be the reservation for that? Then pre-IPO placement, as we call it. So everything has to be decided beforehand before going for IPO.
Ashwini, someone is asking, how much time required for the SEBI to approve the DRH?
So it depends how many questions SEBI is raising to you and how you are able to answer that. But how much would be, Madhulika, the maximum time you can get an approval?
I think it depends on the kind of observations the SEBI is giving. So some companies even get observations within 30 days or something like that. So, and post receiving the observations, we have to work on it, and and then file the updated DRHP. So those normally 2 to 3 months goes while we are doing that process.
Right.
Actually, there is another question is actually coming for the due diligence process period. What is required, say 3 years, 5 years, or any standard rule available or something like that?
I'll take that question. It won't take 3 or 5 years. You don't need to start so early. I think a year in advance in nowadays is sufficient enough. Again, subject to the size of your company, whether how many subsidiaries you have, how many associate companies you have. Based on that, I think a year, 1.5 years before preparation is comfortable.
No, Sujoy is asking records.
Oh, record. I'm sorry. So record, I think there are some permanent records. Your minutes will be checked from the date of your incorporation. So you will have to have those in process. Now, for a company like Indigo Paints, it's a 20-year-old company. When many forms were filed physically, Bala sir will obviously relate to that. So it's a task taking out those forms, and because ROC themselves do not have those records in place. So
as you rightly say, I also undergone a due diligence, not once. I undergone a due diligence about 4 or 5 times, because the company where I was working, it was actually initially it became a public company, then subsequently it became a Burma Castrol Group company. Later on, it became a venture capitalist company. Then it was taken over the Vesuvius Group company. All these things were there. Every stage there was a due diligence. But as you rightly say, every stage of the due diligence, first and foremost thing, these companies also won't be something about 50, 60 years old at that time. Now it is 70 years old. So what they have done is, specifically they said, give me all your articles right from the day one, whatever the amendments you have done. What we used to do those days, amendment, whenever we made the article, we used to change the color of the articles. By memory, I know, oh, blue color, it was the original one. Red color, it was the next one. Oh, again, it is a yellow color, it was the third one. Like that, every time when the amendment takes place, that we say, we also print, it is amended as on this particular date. They used to take that, then they used to go through each and everything, and they used to find out. That is what they used to do in the case of the due diligence. As you rightly say, it is not 3 years or 5 years or something. It depends upon what sort of the document they are actually looking for, what sort of the policy decision company has taken, what is affecting it. That's what they will look into. Yeah.
But what I think here is important is the capital buildup. I think it is taken from day one. I understand it. Howsoever old the company is, the capital buildup from day one is done for the company. That is very important.
Yeah, it depends on the type of information it is. Suppose if it is, so for example, he said minutes of the meeting or the statutory records, it is since inception. Then there are certain things like, if there has been any penalties or any compounding. So for that, I think they take 3 years as a threshold. So for financials, it is 3 years. So it depends on the type of information it is, and then the period as per the ICDR regulations, it is taken up by the merchant.
And suppose the mandatory documents are not available, is any representation taken from the management for that particular period?
If it is not available and the compliance was not done, then you have to first get the compounding done and solve that matter and report that matter in your risk factors as well. And wherever the disclosures are required, has to be mentioned specifically.
So if you check the risk factors of maybe companies which are incorporated before 2006, when the digitalization process was coming in, you will find this risk factor almost in each and every company's DRHP, stating that there are certain records which were in physical format which are not traceable, and the company has, XYZ tried to do as much as possible to get the records, but it was not found. So this risk factor would be there in 99% of the cases.
Most of the cases where the issue cannot be resolved, definitely a disclosure in the risk factors is available in most of the companies, and you will find it in every company. Something or the other would be there.
Yes.
So disclosure is very much required. I want to take one question which I think Gaurang Parekh has asked. This is regarding the preparedness of the company before they get listed for few of the important matters like related party transaction policy that he's specifically referring to. Definitely, I agree. When you plan for getting listed, you have to be mentally prepared as a company secretary what is coming to your plate. So, for example, a related party, and there are various other policies which become applicable, and you have to definitely start putting things in place and start practicing it as well. So, as you know, for example, I'll tell you one more regulation is insider trading regulations, which is now every day we are getting amendments. And before you get listed, you have to educate your employees the impact and effect of insider trading regulations, and the preparedness has to be there from before, and educating yourself and educating the employees of a company is the responsibility of a company secretary, and you have to start almost a year before or whenever it is possible for the company.
You are absolutely right, Madhulika, because the moment, because today you are talking about LODR regulation, those days it was corporate governance, class 49 of regulations.
Correct.
Listing agreement. So what he is talking, the various things, the day one you realize you are going to go list, you have to start preparing it so that you know what happens. There are certain things when you are actually on the due diligence sector, insider trading will automatically apply from the day one actually. It is not after the listing it applies or something like that. It applies from that day only.
Correct.
And all other things, as and when you start doing it, you have to comply with everything. The moment the listing comes into, everything should be in place. That is the preparedness one has to do.
Yes.
I think just to add on that, as rightly said by both Bala sir and Madhulika, we have to understand the psyche of the management also. They're running this company or any company at a specific style. To tell them at one go you have to change everything together, managements are usually rigid on that part. So as rightly said, when the decision is taken for the IPO, we as company secretaries, we can start sensitizing the management from day one, and gradually start making the changes what is mandatorily required.
If someone is asking, should a peer reviewer PCS do the IPO due diligence?
I think that's not a mandatory requirement. Should a peer
That is
reviewer
not a-
PCS? Yeah, I think that's not a mandatory requirement.
It's not mandatory.
Is there any provision relating the time limit clearance of DRHP under the ICDR by SEBI?
If I'm not mistaken, the first observation should come in within 45 days of filing.
Does SEBI has a right to reject DRHP?
Yes.
If that is the case, what are the consequences in case of the rejection?
Yes, they have the right, definitely.
Now, consequences, I
cannot come out.
see in the
Yeah.
practical aspect, I think the merchant bankers will not allow you to file the DRHP if it is not as per SEBI's requirements. So this rejection criteria would trigger. I've not seen any DRHP getting rejected in the past 2 or 3 years at least.
But they will give their observations and
Yeah,
you will-
observations is
yeah.
They
Yeah,
won't
that-
reject it.
Yeah, that is what it normally happens. They come back with the observations and other thing and all. Whatever the action is to be done, that has to be done. We have to again get back to them. That's what I also believe. Outrightly, I don't think they will reject it. A 60-year-old company get a DD done, and the auditor find out that 10 to 20 years did non-compliance of the company is required to do compounding before IC. Yes, compounding is required to be done. Without the compounding, nothing can go. If there are a non-compliances, first and foremost things will be a compounding should be done actually.
Yes.
Yes.
Your councils will not file the DRHP without you do the compounding. They will not move ahead itself.
And the
You know,
impact
merchant bankers-
of that non-compliance is also very important. So
Yeah.
the impact
Merchant bankers will not be comfortable. So they will not do it.
Is it required to present share transfer document? Not, I think it should be required to preserve share transfer document. It should be. I think subject to that reasonable period or whatever is there, we have to preserve it. Actually. You cannot get away with that.
So as Ashwini was mentioning earlier that anything related to paid up share capital or share capital of the company,
Yeah.
all documents right from starting have to be maintained, including share transfer form.
Correct.
For some reason, if it is not present, the lawyers usually do not accept that. You will have to take steps to, locate those documents.
Can SEBI has the power to give approval clearance in case of the inquiry investigations going on against the company?
that is disclosed in your prospectus, if it is taken as a risk factor, then yes, then SEBI can go ahead.
I
Also
think
depends on the impact. Ultimately, what is the impact?
Depending on the type of matter it is. If it is capital,
Normally, I think it is in the document itself, it is indicated these are the various litigations, these are the investigations, these are all there, and it is going to be the impact, it is going to be the outcome that is actually disclosed. I think depending upon that, SEBI can raise a query and come back on this, etc. That is what I feel. It is not that SEBI will give the outright approval or clear, that is not there. As you rightly said, disclosure will be required each and every matter.
yes.
So moving on, next would be the compliance with SEBI regulations on corporate governance, including the board composition that will come into picture, I think 6 months to 1 year prior to getting into that IPO phase. But I think 6 months is enough time when you start complying with the SEBI regulations, and assuming that you are a listed company, you would start all your compliances, your composition accordingly. There will be the board composition, everything will happen as in a listed company. Then audit requirements and audit timeline, because we need to do the restatement of last 3 financial statements as per in Indian accounting standards as per SEBI. So that is an important activity pre-IPO. Then advertising and promotion campaigns, it should adhere to publicity guidelines that is given by SEBI. Then DRHP filing after 1 year from the bonus issue date. If it is done, so there is a concept of lock-in that happens after IPO. So I will discuss on the lock-in of shares after we have covered the other provisions. So DRHP should be filed after 1 year from the bonus issue. Otherwise, the entire pre-issue will be locked in. Then completion of all corporate restructurings and completion of all acquisitions, disposals, or disposal of undertakings. So everything that you've decided. Another major factor could be that the approvals are quite easy to get in before you are listed, then getting it done after you're listed, because then the large number of shareholders come into picture. So you complete all your restructurings, all your disposal, acquisitions, everything prior to going public. So there's a question, any good publication guidance note by ICSI? I think there is a guidance note by ICSI.
Yeah, they have written very long time back, actually, the practical regulations in respect of the IPO. There's a publication which has actually come, even from my time, it is there actually. I think they would have definitely modified from time to time. ICSI publication is definitely there.
Also, if you go through SEBI ICDR regulations, I think they are very good enough, and I mean, there is a lot of clarity if a company wants to go in. So what is the do's and don'ts come out of the SEBI ICDR regulations. Then once we are done with all the pre-management activities, first and foremost important thing is you have to go ahead and appoint a merchant banker. Regulation 23 requires that issuer is the company which is going with IPO, shall appoint one or more merchant bankers registered with SEBI as lead merchant bankers. So the criteria for appointment is provided in Regulation 23. The company seeking to float an IPO shall appoint one or more merchant bankers to prepare the draft red herring prospectus.
Here, Ashwini, I'll just add on. For the companies, it is very, very important, and who do you choose as a merchant bankers also matters a lot, because merchant bankers have a very important role to play for making your IPO successful. So there would be more than one merchant bankers appointed by the company, and the roles would be bifurcated amongst them. And definitely, the lead merchant banker has a very, very important role to play for the successful IPO.
Then the due diligence and DRHP preparation, it is done by the merchant banker. So due diligence can be done from the company's side, that wherein it appoints some practicing CS or a legal firm or a law firm to do the due diligence for the company, which is from the company's side. Whereas a separate due diligence is also done by the merchant bankers, because they have to certify on the compliances of the company. Then next is display of offer document on website. So display of offer document on website. Merchant banker shall display the offer document on its website after final approval is obtained and RHP is filed with ROC.
Yeah, go ahead.
Yes, another important activity that a merchant banker will do is the market making arrangement, the underwriting arrangement. Sujoy or Madhulika, would you like to throw some light on any of these?
I will just talk about talk little about the underwriting arrangement. Normally in IPOs, although it is a process requirement by ICDR to get an underwriting arrangement or an agreement done by the merchant bankers, but generally this has not been a practice, and they actually just sign an agreement, but nothing of underwriting kind of a thing. That obligation generally they don't take. So it's just from the regulations point of view, which has to be done. So they take it from that point of view. So that's what I just wanted.
On this to Madhulika's point, that I mean, the marketing wing of these merchant bankers are very strong. I mean, they'll already get the feeling as to, and express it to the management, that how is the investors or the potential investors, having interest in your IPO. So you'll get the feeling. So this underwriting thing, as she rightly said, is mostly on paper nowadays. It's not required anymore practically.
Nowadays, do they still undertake the road show, etc., and all those things, which used to be the case in our time?
Roadshows are still there. Roadshows, so it is required for your marketing. Unless and until that marketing is done, you don't know how many investors are showing interest in your company. accordingly they get a fair idea when to launch the IPO or not, because merchant bankers accordingly get the feel like, is this the right time to launch the IPO for this company or no, or should we wait, or how we have to go about it. So roadshows are very, very important, and it is still on. Without
Yeah, and
roadshows,
Bala sir, I think it's done between the DRHP, RHP stage till now, and
yeah.
I think both Madhulika's IPO for Burger King and my IPO came during the COVID time, where going physical roadshows were quite a big task. So we have done it through Zoom.
Yeah, I remember somewhere in the year 1994 or something, when the company went to public, I had an opportunity to travel Bharat Darshan along with my directors. That is why I
So,
asked this question.
I will just share the experience of Burger King here. Ashwini knows it rightly. Like, before even I joined Burger King, the IPO document RHP was filed with ROC as well. We received the ROC approval as well on that. But as recommended or as advised by our merchant bankers, the lead merchant bankers, that because that was the time, it was March 2020, and actually that COVID peak time had started. We were recommended not to go ahead with the IPO during that time, and we had to withdraw the our prospectus from ROC filing as well. So then, as per the advice of the merchant bankers, then we had to wait. We actually waited for the COVID to settle down, and then we, in the same year, in November, December 2020, we filed our prospectus. So even after going up to that stage, the withdrawal can happen. Depends on the market situations.
There's another question has come actually. What are the document information to be uploaded, disclosed on the website during the period from the filing of DRHP, the listing under the SEBI regulations?
I think the restated financials for 3 years are compulsory to be uploaded once the DRHP is filed. That is one document which comes to my mind right now.
And if you have a website, obviously all Companies Act compliances you have to comply.
Companies Act compliances plus policies of the company, corporate governance till whatever extent it is applicable to the company, those things are all required to be uploaded on your website.
Another question is there, is it compulsory to give 5% share to the market maker out of the company's pocket towards market making for future period of 3 years? I'm not clear what exactly is being asked here.
Market maker in the sense what, if you can clarify as to what exactly is required in this
No, I'm
question.
not very clear about the question actually here. Nilesh, are you there? Can you speak actually? What exactly is the question?
Yes, sir. I can clarify the question.
Yeah.
One of my friends has told me that while going for SME IPO, he has given 5% share of total IPO amount to the market maker out of company's pocket. He has used that share as a market making, and whatever profit he was making, he never give it back to the company. So it is compulsory for every company to give the shares out of company's pocket, or is it the responsibility of a market maker?
So SME IPO is altogether a different thing. I cannot disclose it on this platform how it is done, but that provisions are entirely different in case of SME IPO. Market making is important factor for SME IPO according. We can take this up.
Okay.
What is the standby arrangement? If is it different from the underwriting arrangement? I think it is
Standby arrangement as such, I don't think it is coming anywhere in our ICDR regulations also. I don't know. Underwriting arrangements are basically when you enter into an agreement for underwriting, it is from the merchant bankers and from the syndicate members, and not from any other than those. And standby arrangements, that depends on your merchant bankers, if they are having any investors in pipeline. If your issue is like full, like if they have certain investors who are as per their discussions, they are 100% sure that they're going to invest, And still, apart from that, at the end moment, if anything happens and this person, if one particular investor is not investing, then they can keep a standby arrangement. There is no harm in doing that. That is, I think, merchant bankers take care of that.
No. A standby letter is very often given by a group company, a strong group company, which says that in case the issue is not fully subscribed, I will stand by and make good the difference. It's not given by the underwriter, but it's by another group company, a strong group company.
No, I haven't seen that. I haven't seen that yet.
I have done it myself.
Okay. Okay, because I haven't.
This was of course not in the current times. This was somewhere in 2009, I think, or 2010. It was a letter of it was a standby letter, which stated that if this does not come through, we will invest the money, and for that the company was also given a certain commission. It was thought that this would be just cream because we may not have to do anything, but ultimately we had to do, and we had to put in money and take shares. It has nothing to do with the merchant bankers. It is an intra-group arrangement.
Okay.
I don't know if that is allowed now.
I don't know. I don't know whether it's allowed now or not. I'm talking about 2010.
So I think it's
that's the reason why I'm asking the question.
so you think if there is under subscription at that time, somebody will pitch in. That is what you're saying.
Yes, exactly.
So
And
now the ICDR regulations say if there is under subscription, it's not. I guess you have to refund the money or something.
See, that is what the minimum subscription is 90%. If you don't meet the 90% criteria, then you have to.
No, before you fall below 90%, the standby person comes in and puts in the money.
So this is an internal arrangement.
Group internal arrangement. That's a different thing. But
Yeah.
ultimately,
that letter is called a standby letter of support.
So that is between the companies and the group companies if they want to have that arrangement, but not coming from an ICDR regulation perspective or SEBI regulation. This is internal arrangement. Plus, at the same time, the percentage criteria of how many QIBs have to invest, and that particular criteria has to be met. If that is not met, then your ICDR regulation criteria is not met, and then the issue cannot go further.
But what you're telling me is that current regulations do not cover standby letters anywhere.
No.
No. Okay.
No.
Okay. Thank you.
Then we'll go ahead with the DRHP. What are the salient features of?
Yes, please go ahead.
So, what are the salient features of DRHP? The DRHP will contain the business description, the financial information, the risk factors that have come out from your due diligence and which have been compounded, or the legal counsel or the merchant banker's speech should still form part of your DRHP. The use of proceeds, how you're going to use the proceeds. What is the plan of action for the company once the money comes in? What is the industry overview? And who is the management? So these all form part of your DRHP. You can go through a lot of DRHP. I think they are available on SEBI website once the company files, and you can study these documents. These are usually done by the merchant bankers.
I just want to add a little on the risk factors specifically. This is the most important chapter of a DRHP or an RHP. This is drafted in as much detail as a company can, put in the details. Nothing should be hidden in the risk factors, and it is on the company also, from voluntarily to disclose whatever the facts are, because ultimately the investors take a call for investing, whether they want to invest in the company. They definitely refer to the risk factors chapter, which is the most important chapter in the RHP.
And to add to Madhulika's point also, I guess majority of the observations from SEBI after you file the DHP comes on these risk factors. And it's always advisable, to voluntarily disclose it rather than SEBI finding out something which you have not disclosed. Because once that comes into picture, and that SEBI will inform you through an observation. And if that is the case, then the whole attitude of SEBI may change towards your DRHP, and it may cause a delay in your filing. So it's always better to, voluntarily disclose whatever we know, And I think the lawyers, the legal counsels nowadays are more proactive towards this section. Coming to one more thing, as a part of the marketing activity or how your issue sells, industry overview is also an important part as to how you draft it, because all your institutional investors who are nowadays your key investors in an IPO would read this, and the more better this is drafted in consultation with management and your international lawyers and your merchant bankers, the more chances are that your IPO sells more in the market.
Now, these are the key intermediaries and their roles in the IPO. First is BRLM, book running lead manager. He'll do the entire overall transaction management, the due diligence, the regulatory interface, investor interface, and marketing. So as Madhulika has said earlier, that the actions will be divided between the merchant bankers. Accordingly, they'll decide which transaction or which thing the merchant banker will follow. So overall transaction management falls within the BRLM's role. Then there are two types of counsel that they appoint. One is the domestic legal counsel and one is the international legal counsel. The domestic legal counsel will do the due diligence, the drafting of offer document, then advisory on Indian legal and regulatory issues, drafting of agreements and issue of opinion for the company and the BRLM. The international legal counsel would come into picture when there is a legal advisory on international legal regulatory issues and international wrap of selling restrictions and legal opinion. So Sujoy, I just wanted to know whether international legal counsel is mandatory for all types of IPOs?
No, if you are looking to tap in foreign investors, then only ILC is required. Otherwise, it's not required. But nowadays, everyone looks for investors. So it's basically called a 144 issue, where you are going to, the US, not getting listed there, but you want to tap those investors. And not only US, your Singapore, all these countries. So if you are looking for foreign investors to invest in your company, then ILC is required. The reason why ILC is required at that point is your business section, which contains a lot of information, which is related to your current business, your prospects, everything. That has to be according to the laws of those countries from where the foreign investors are coming. So the ILC will make sure that you're not putting anything, which may cause you trouble in the future. So that is where the role of the ILC comes. So if you're not looking for any foreign investors, I don't think ILC is required.
One more question has been asked. What is the reference or meaning of the words red herring or dropped red herring prospectus?
Can he elaborate on the question? I mean, I didn't understand quite.
Shailesh bhai.
So unmute yourself, sir. Shailesh sir, unmute yourself.
Yeah. Oh my God, now I've lost it. Okay. Google says misleading. The meaning is given as a clue or piece of information which is or is intended to be misleading or distracting. Misleading or distracting. And we have got those words in draft red herring prospectus. Why do we use the words red herring? Can it not be just draft prospectus? What was the intent, purpose?
Well, I don't know whether the my
Good question. We'll check with SEBI. So actually, even I don't have an answer for that.
I do have one idea, because I had asked the same question to one of the merchant bankers when we were having this IPO.
Okay.
So, I mean, what they said is the prospectus is basically a disclaimer and a liability document. Okay, whatever you put in it, you can be sued afterwards. Okay.
Yes.
So that is why, since it's a disclaimer or a liability document, it's called red herring. So red herring would mean
drawing
herring
attention.
is disclaimer, and you're putting it in red. That means you're highlighting your liabilities and your disclosures is why it's called red herring prospectus.
I would fully agree with you. Red herring could mean drawing attention, but when I refer to it in Google, the word misleading is used. Maybe it would be worth checking, Ashwini.
Yes.
Okay. In fact, the word came in when I used to be a company secretary, that SEBI introduced that word at that time.
Yes. I think in 56 Act, there was this reference also of DRHP.
DRHP.
Then there is another legal counsel, the Selling Shareholder Legal Counsel, which will be doing the agreement, disclosure in the document, certificate, opinion, consents, that would be its role. The auditors who are responsible for preparing restated financial statements and other audit related deliverables. Then the registrar and transfer agent, as we call RTA, who will do the post-issue coordination, collation and reconciliation of information, and assistance in allotment and process of listing and trading. Advertising agency, formulation and execution of the media and PR strategy, organizing roadshows and coverage of IPO and positive news flow. So I just have one question in the registrar category. So post-issue coordination, like allotment and everything is done by RTA or the syndicate agencies that are appointed, the self-certified bankers, who actually takes care of allotment and everything?
The allotment is taken care by registrar, but there is a lot of coordination between the registrar and the syndicates, because ultimately the information which flows to the registrar is through them. So, but the process part is taken care by RTA, that is the registrar.
Okay. Then industry report agency, publishing an updated industry report, extracts from the report to be used in the industry section of the DRHP. Then the various legal agreements that the company has to enter into. First is the engagement letter with the BRLM. The company individually has to enter with investment bankers, counsels to the company, auditors, registrars, and other intermediaries. Then the purpose of the agreement would be engaging the intermediaries for the services, which lays down the roles, responsibilities, and of the BRLM, representatives of BRLM and the company. Then the second is the escrow agreement. Company will enter into with BRLM syndicate members, registrar and escrow bankers to the issue, which lays down the process for receipt of issue proceeds and release of funds to the company. Then the syndicate arrangement will be between company, BRLMs and syndicate members, which lays down the process of marketing and handling the forms. Then the next would be the underwriting agreement, which the company will enter into with the underwriters, BRLM and syndicate members, which lays down the terms of underwriting and extent of underwriting. Then the tripartite agreement with the depository, the company will enter with NSDL and CDSL, who will act as depositories of the company. Then the listing agreement between the company and stock exchanges, which will bind the company to comply with the requirements of the listing obligations, the SEBI LODR. Then the preliminary check that a company has to do with regards to IPO would come out from regulation of ICDR, regulation 5, which will say that the issuer, its promoters, directors, promoter group are not debarred from accessing the capital market by SEBI. The issuer, its promoters are not willful defaulters. Then the promoters are not promoter, director of a company which is debarred from accessing the capital market or fugitive economic offender. So when there is any of these, I think the company is straight away barred from entering into an IPO or getting ready for an IPO. Then the second is there are no outstanding convertible securities except outstanding options granted to employees, fully paid up outstanding convertible securities which are required to be converted on or before the date of filing of the red herring prospectus. So if there are any CCPS or CCDs or anything in the company, they have to be fully convertible. Is that the case, Sujoy?
Yes, Ashwini, that is the case. CCPSs have to be compulsorily converted, or any convertible instruments have to be compulsorily converted before filing of the RHP. Till DRHP, you can carry that. till your SEBI observations are over. But after that, you will have to compulsorily convert it before you file RHP.
So only options are exempted.
Only options are, yes, under the ESOP scheme.
And what happens to the share warrants? Whether they have to be converted as well, because they are also considered to be options only.
So share warrants, I don't think they have to be converted because they are kind of options and not convertible instruments per se. But I'll just bring one important point here is most of the investors, I mean, I'm talking about PE investors, will have their voting rights and all of these linked to the CCPSs, okay, or the convertible instruments. So it is very important to hold this discussion with your PE investors before you get, to this IPO process as to, the conversion has to happen and what are the terms and decisions, what the PE investors are comfortable in going ahead with.
Then all the specified securities held by promoters are in demat form prior to filing of the offer document. This we have discussed earlier. All existing partly paid up equity shares have been fully paid up. Then the issuer has made firm financial arrangements of 75% of the stated means of finance, excluding funds to be raised through the proposed issue or internal accruals. Then the amount for general corporate purposes shall not exceed 25% of the amount being raised by the issuer. Then the promoter definition and promoter's contribution. So where it is possible that this definition comes out of SEBI ICDR, but there are certain issues where the promoter can be defined. But what happens where the promoters cannot be defined, then it will be called as a professionally led company. In that case, you have to define accordingly, but where the promoters can be defined as per the Companies Act and as per the SEBI ICDR regulations, you have to define in your DRHP the promoters. So basically the definition comes out of section 269 of the Companies Act, which says that promoter means a person who has been named as such in the prospectus or is identified by the company in the annual return, referred to in section 92, who has control over the affairs of the company directly or indirectly, whether as a shareholder, director or otherwise, in accordance with whose advice, directions or instructions the board is accustomed to act. So there was this very weird question one person had asked, that if they do not want to show the person as promoter in their DRHP, can they go back and change their annual returns or not show him for the next 3 years as the promoter? So I don't think so that this can be done, because then SEBI would be checking your documents, not SEBI, in fact your merchant bankers, the BRLMs would be doing that due diligence check and seeing that you have been disclosing this person as a promoter and suddenly you have stopped. So that is not possible. If you have disclosed a person as your promoter, it continues to remain in your document.
Yeah,
Someone is asking, please define general corporate purpose.
So general corporate purposes would be anything, 25% is allowed. So it can be a brand building activities or advertising expenses or something like that, which for GCP or as it's called general corporate purposes, you don't have to disclose your exact plan as to how you will be, investing that money. So the most common GCPs would be advertising, acquisitions, and so on and so forth.
Madhulika is saying something?
No, I was talking about the previous slide. In the promoter, basically it is said that once a promoter, always a promoter. So if your name is there as a promoter, you cannot suddenly stop putting that person's name as a promoter or a promoter group. So there are, and recently from SEBI point of view also, if you have to declassify them, then there is a separate process which has to be done for declassification. So promoter category is, you cannot skip that particular part.
So you're saying you show him as a promoter and later go in under regulation 31A of SEBI and
if you want to declassify. Yeah.
There's one question, sir. the company X is going for IPO and company X is having 2 subsidiaries deemed a public company, whether shares of those subsidiaries are also required in demat mode. Yes, I think that they'll be deemed public company, and regulation, I think under the Companies Act, they are required to maintain in demat.
Yeah,
But new issue and fresh, any transfer or fresh issue of shares.
Yeah, it will be required. Demat is compulsory.
So a financial institution, scheduled commercial bank, foreign portfolio investor, other than individuals, corporate bodies and family offices, mutual fund, venture capital fund, foreign venture capital investor, holding 20% or more of the equity share capital is not a promoter, because the proviso to the section 2 of the Companies Act says that nothing in clause C shall apply to a person who is acting merely in a professional capacity. So the next definition that comes out of SEBI ICDR is the promoter group. So who all fall under the promoter group category: the promoter, immediate relative of the promoter, and in case the promoter is a body corporate, then these conditions that 20% or more of the equity share capital has to be held by the corporate, and so will fall. Similarly, in case the promoter is an individual, body corporate in which 20% or more of the equity share capital is held by the promoter. So 20% is the criteria given. If it is exceeding 20%, that promoter, if it is a body corporate or an individual, will form part of the promoter group category under SEBI ICDR regulations.
Ashwini, I think following to the earlier question, the gentleman, there is a question has been actually put. If the company has already followed the reclassification of the promoter, then also you need to have the promoters in the process.
Sheetal, can you just explain your question?
Sheetal, can you unmute and talk?
Yeah. Actually, sir, company has already followed the process of reclassification, and now there is no any promoter. So it is like shareholders are running the company. So for that also, for if company wants to go for IPO, then then promoter needs to have in the company.
No, it can be said that it is a professionally led company that has
Yeah.
to be stated. Yeah, there is no requirement of promoter in that case.
No,
Okay.
not required. For example, I can give you in Yes Bank, it was not an IPO, but it was an FPO. We had done the reclassification of promoters, and then the whole requirement of the promoters details and that particular thing was not required.
Okay. Yeah. Thank you, ma'am.
In this context, can we have a statement in the prospectus saying that as per past record, so and so is the promoter. However, he declares that he will not take on the responsibilities of promoters, and investors should bear this in mind while investing in the company, in the issue. Can such a statement be, is it valid at all? I'm absolving myself of my responsibilities. You invest if you want to invest. I'm making it clear.
As Madhulika said, once a promoter, always a promoter. I don't think he can absolve himself from this.
He cannot. What did you?
Cannot.
Cannot. I see. Okay.
So once the promoter has been defined, later the promoter has to also bring in the minimum contribution at least 1 day prior to the opening of issue. That is, he shall hold 20% of the post-issue capital. Only exception is there is no identifiable promoter in your company. The eligible securities would be by way of equity shares, superior voting right equity shares, convertible securities. Minimum contribution. So this minimum contribution lock-in period is now changed. From 3 years, it has become 18 months under the latest amendment of ICDR. I think in May it has come. So 3 years has gone down to 18 months now. And ineligible securities would be securities acquired for consideration other than cash or from bonus issue during last 3 years. Securities acquired during last 1 year at price lower than issue price, subject to certain exemptions. Securities pledged with any creditor. So these are the ineligible securities.
One thing, Ashwini, here in the you rightly said that it has been reduced to 18 months. But if your majority of your the utilization or the object has capex involved into it, then it is still 3 years.
There's one more question has actually come again on the promoter related one. Need clarity on clause B of the promoter definition section 269. Can all the relative of a promoter of unlisted company are deemed as promoter?
So you have to follow the relative definition under Companies Act, and all those who fall under that would be the relatives. Not all relatives, obviously.
Okay, move on.
So once you've decided to go listing, the stock exchange requirement for the minimum post-issue paid-up capital in case of BSE would be 10 crore, and minimum issue size of 10 crore and market cap of 25 CR. In case of NSE, similar requirement of post-issue capital of 10 crore and market cap of 25 crore. Then there should be no disciplinary action by stock exchanges and regulatory authorities in the last 3 years. Details of litigation of issuer, promoter, group companies, companies promoted by the promoter for the last 3 years, and track record of directors. So this is an additional requirement of NSE that comes in at the time of listing. So now we'll go ahead with the IPO process flow. So how the company would initiate the process for IPO. The first and foremost step that the company has to take under Companies Act, that would be there should be a board resolution to approve the issue. The company should conduct a board meeting wherein it will approve the issue. It will constitute a subcommittee, which is usually known as the IPO committee. It will appoint all intermediaries that we have discussed in the earlier slide, and a compliance officer if it has not appointed till date. Then the terms of offer, then adoption of new memorandum and articles of association. As we had seen the pre-management activity, the first step would be amendment to articles or adoption of new set of memorandum and articles.
That's another question is there is subsidiary of a holding company, say X, associate of that company, that is X is related to each other.
Yes, they are related.
I think under related party transaction, parent and subsidiary is always related. So
Yes,
it will automatically come as a related. Because
all
company,
the group company, associate company, subsidiary.
yeah, Company Act very clearly says they are related. It will be related. Yeah.
I think his question is from the part, I think it is coming from the fellow subsidiary or accounting standard point of view. Yes, it is.
Yeah, it is.
Yes.
Definition is very clear. It is related party. Yeah, go ahead, Ashwini.
Then the second step is appointment of one or more merchant bankers, which comes out of Regulation 23. It has to be done within 30 days of holding the board meeting where issue has been approved. Then the next is enter into agreement with the intermediaries. You have to enter into the various agreements that we have discussed. Appoint intermediaries in consultation with the lead manager who shall independently assess the capability of other intermediaries. Syndicate member in case of book building, registrar to the issues, monitoring agency, depository participants, stock exchange, underwriting agreement if required. So these all entering into the agreements should happen within 60 days of the board meeting. Then you have to appoint a compliance officer. As I said, if it has not been appointed, then within 60 days of the board meeting, it should be he should be appointed. Then the due diligence shall be completed within 3 months, that is 90 days from the date of the board meeting in which the issue has been approved. Then all of this is done. Then the first step, as per the SEBI regulations, ICDR 2018, would be filing of the draft offer document with SEBI. You have to file 3 copies of the draft offer document through the lead manager. Then you have to file the draft offer document with the stock exchanges. You also have to apply for in-principle approval from stock exchanges. Within 2 days of filing the draft offer document, you have to apply for the in-principle approval. Then the receipt of in-principle approval will be within 30 days of making the application. You have to ensure that you receive the in-principle approval. Then you will receive the final observations. Sorry. Then you receive the observations from SEBI. So it takes around 2 to 3 months, as we discussed earlier. First is you have to receive within 45 days. And after that, within 3 months, you should get an approval from SEBI for the DRHP. Then you have to submit an updated draft offer document after complying with the observations issued by SEBI and highlighting all changes made in the draft offer document. Then you receive the SEBI approval once you have made the changes. Then you have to file the offer document with ROC. I think on the same day, you must also have your board meeting for the approval of prospectus. You have to get approval from the ROC on the same day. And then the copy of offer documents shall be filed with the SEBI and stock exchanges through the lead manager. The draft offer document shall be furnished to SEBI along with statement that SEBI's observations have been incorporated. The due diligence certificate, I think it is given by the merchant banker, the due diligence certificate. Then the board resolution for allotting specified securities and the certificate from statutory auditor. What would the certificate from statutory auditor be regarding in this case? Whether they can go, what would they be certifying, the statutory auditors?
They basically give the comfort. It's kind of a comfort letter from them, I think.
Then the draft offer document filed with SEBI shall be made public for comments, if any, for at least 21 days from the date of filing by hosting it on the website of SEBI and the stock exchanges where it is proposed to be listed. Then after that, you have to make a public announcement in one English national daily newspaper, one Hindi national daily newspaper, and one regional language newspaper at the place where registered office of the issuer is situated, disclosing the fact that the draft offer document with SEBI, that the document has been filed with SEBI and it is inviting public comments to provide to SEBI, issuer or lead manager.
Oh, the newspaper publications now in Hindi, English, and also vernacular 3, is it? Because I think in our time it used to be only English and the vernacular language. Now you are actually saying it is the 3 languages, is it?
Yes. So after expiry of 21 days, the details of the comments received from the public, if any, on the draft offer document and the consequential changes, if any, that are required to be made in the draft offer document will be filed with SEBI. The issuer shall, after filing the red herring prospectus or prospectus with ROC, make a pre-issue advertisement in these 3 newspapers. Then the issuer shall announce the floor price or the price band at least 2 working days before opening of the issue in the same newspaper in which pre-issue advertisement was released. Then IPO will be opened within 12 months from the date of issuance of the observations by SEBI. It shall be opened for at least 3 working days from the date of filing the red herring prospectus and prospectus with ROC. It shall be kept open for at least 3 working days and not more than 10 working days. Then the finalization on the basis of allotment is finalized in a fair and proper manner in accordance with the procedure specified in Part A, Schedule 14. Then you have to submit a final post-issue report along with a due diligence certificate within 7 days of finalization of basis of allotment. So this report, post-issue report, I think is given by the merchant banker to SEBI within 7 days of refund of money in case of failure of issue. Then advertisement shall be released within 10 days of completion of the various activities in one English, Hindi, regional language newspaper. So this is regulation 51, but whether SEBI LODR will come into picture here or no at this point. That you have complied with all the regulations?
LODR, From what angle are you talking about?
That here the completion of various activities have been done and the company, so is there any requirement under LODR for the same?
No.
No, not at this stage.
No.
You know, once a LODR comes to the picture, the moment you get into listing.
So there is, after the allotment, there is a time lag till you get the listing approval. So
Yeah.
this happens generally between that time.
Okay. Then the allotment of shares, filing of return of allotment and application for final listing and trading approval will happen post completion of the activities mentioned under ICDR. So these are the IPO work synopsis. One is the pre-DRHP filing, wherein the due diligence, drafting of DRHP and the deal research will happen. Then the second part is the SEBI review period, wherein the SEBI review will happen, IPO grading and appointment of intermediaries. I think IPO grading is not mandatory for all types of issues. The company can voluntarily go ahead and decide to grade the IPO. Then the issue marketing, wherein institutional, non-institutional advertising and PR will happen. And post-issue activities, post-IPO support and all compliances will happen in this period. So this is the roadmap for an IPO from a public unlisted company to a listed company. So these are the 4 stages from how a company from a unlisted company goes to a listed company.
One small thing during the whole process, however, the process here very well and in a very summarized form, Ashwini has presented. But during this process, the process which happens in 2-3 months, it is the company secretary is almost on toes. Whatever time you have to be ready, and also you have to be in very well coordination with your directors, because various approvals need to be taken at various stages. So there is a lot of coordination, everything required from the board of directors as well. And generally there's an IPO committee, the companies form, so that it is easy for them to get the right approval at the right time, the approvals from the committee. And it is advisable to have those directors on that committee who would generally become available at whatever time you expect them to be available, because there are certain things on which we require approvals on the same day, whatever time it is. So those requirements are there. For example, when we have the anchor investor day, one day, which is one day before your issue starts. So those coordination, and this is just an advice given for the company secretaries to handle at the last minute criticalities.
So whatever we've discussed earlier, this is the timeline given, like from the date of board meeting to approval of the issue till the date it is listed. Within 6 months, this timeline is provided within what dates you have to do what activity is given here. So there are 2 types of IPOs that we can say, wherein like a process that we follow for the IPO. One would be the fixed price process and the book building process. Sujoy, I would like you to throw some light on the book building process, because I don't think fixed price process is happening these days, or majority of the IPOs come out with the book building process.
So book building is synonymously called as price discovery method also, where price band is given, and within that price band your shares are the investors invest in your company. As you rightly said, fixed price process I think is now again in part of the books. Practically majority of the issues are now under the book building process only.
Madhulika, would you like to say something?
Yeah, I agree to Sujoy that most of the IPOs are now book building. So if you see refer ICDR regulations, then there is one is fixed price, then book building. Book building also there are two types: voluntary book building and compulsory book building. Most of the companies where now in the earlier slide we spoke about it is repayment of debt or something. The companies, like if the company's track record is on from the point of view that they are still under losses or something, that they have to in general go with the mandatory book building, and it is basically for price which Sujoy said that we have to seek this process.
Manish has put up a question saying shareholders approval would not be required for the IPO.
It's required.
It is required.
See, you have to follow section 62 for any fund.
Yeah, it has to record because it's a fundraising activity. Shareholders approval will be required in any case under the company size.
Shows the prerogative of the shareholder.
Yeah.
To take approval.
Yes, go ahead.
So book building process is a process in IPO for efficient price discovery. It is a mechanism where during the period for which IPO is open, bids are collected from investors at various prices. As per SEBI guidelines, an issuer company can issue securities to public through prospectus in the following manner: 100% of the net offer to the public through book building process, 75% of the offer through book building, and 25% through at the price determined through book building. Fixed price portion is conducted like a normal public issue after book build portion, during which issue price is determined. So in book building method, 75% of the net offer to the public can be offered to institutional as well as non-institutional investors who had participated in the bidding process. Not less than 25% of the net offer to public shall be available for allocation to non-qualified institutional buyers. In fixed price method, 25% of the net offer to the public can be offered at the price determined through book building, shall be reserved for allocation to retail individual investor who had not participated in the bidding process. And here, not more than 50% of the net offer to the public shall be available to QIBs. Then total public issue, whereas it is in 100% book building, allocation to retail individual investors would be 25%. Allocation to non-institutional investors will be not less than 25% of the net offer, and QIBs will be not less than 25%. So this is how the demarcation will happen in 100% book building process. So these are the types of investors. The retail individual investor, 35% is the requirement, is an investor who applies for stocks for a value of not more than 1 lakh rupees, who is a non-institutional investor, who are commonly referred to as high net worth individuals. And QIBs are institutional investors who possess the expertise and financial muscle to invest in the securities market. So this is the structure of book building. The investors, the mutual fund, book runner, lead manager, stockbrokers, who can be the investors, here it is given. So Sujoy, can you explain this process? Because technically you'll be able to know how the process is done for book building.
I mean, you have already mentioned the process, and I think more or less this is what it is. I think out of the participants who have recently, 2-3 years have started applying in IPOs, the last point would be quite relevant to them, because all of them have shown around 5 to 10 times or more than that of oversubscription. Some have gone even about 50 times. So the refund and all this, the last portion would be very relatable to all of these people here. But more or less, this is the process. I mean, the UPI technology which has come in recently, introduced by SEBI, that is also quite a remarkable step taken by SEBI to reduce the time from your open of the issue till your listing, so that all the allotments are done in time and your day of listing comes closer, so that your shares are freely tradable. I think I can give that much input. Rest you have in detail given this process.
And also the lien will happen and not actual transfer of funds would happen from the person who is applying from the.
Right. So that is ASBA which you're talking about again. So if you're applying through a banking network or an ASBA partner, before it used to happen, it used to get deducted, then refunds used to be a problem. Nowadays it's just blocked, and if you get an allotment, then only it is debited from your account. Otherwise, that block is basically released after the final list of allottees are,
So is there where the self-certified syndicate bankers come into picture? Like they have to, you have to apply through only them, and then the lien will happen. Is that how it is?
Yeah, so self-certified bankers are there. There are basically more than 50 banks, if I'm not mistaken, who are giving you this, ASBA facility. Nowadays, 99% of the banks have this facility. And UPI still, is a section where SEBI needs to work on it a little bit more, because refunds are still a problem in UPI. We still get complaints from investors even after a year of listing, saying that their money has not been yet refunded to them in UPI. But I think that's a good step taken by SEBI. Needs a little bit more of working on that.
So the IPO process flow would be the same we have discussed earlier, from the appointment till the finalization. So this is given in detail about the book building process. We'll be sharing the presentations with everybody. Lastly, I would like to take up what is the limitation in case of book building process. So in India, unlike in developed markets, it is still dependent on good faith. It is peer pressure and reputation that ensures that there are no defaults. The number of investors invited to apply are limited. Book building relies a lot on interaction among firms, merchant bankers, and investors. There is lack of transparency at critical steps of the book building process. There is absence of any strong regulation at the time. Then more lag time between issue pricing and listing, collective bargaining power of institutions, then high institutionalized holding may affect the stock's liquidity and make it volatile. And the limits fixed are fungible and can be altered depending upon market conditions. So these are the limitations of book building, but otherwise most of the IPOs are done through book building itself in India at the moment. So from here I come to an end, Bala sir, for the presentation.
I don't think there is any questions left over the chat box. All the questions have been already answered, unless participants have any questions. Ashwini, I must congratulate you and appreciate you. You have done an excellent presentation, putting it everything in the capsule form, A to Z. And Madhulika and Sujoy, they kept on adding the practical knowledge. They kept on giving the various hints to the people. I'm very sure the session is definitely a good learning session. I could see the lot of sea change actually, what used to be there those days and now. Because I being a old timer, that I can definitely say that. Because in our time, everything was fixed price. So not the price band. Price band has come much later actually. So that is the thing. So there are a lot of things are happening, but as you rightly say, yes, as we travel along, there will be more and more things we can expect. It is excellent presentation, excellent sharing, good learning. That's what I would say. Over to panelists.
Thanks, Ashwini. It was really a very good presentation. Everything put together. Just a few suggestions or advices for the attendees. It's like just once we go for listing and once we decide for listing, the company secretary is not only the person who will just take the process ahead. As I earlier also mentioned, there is a lot coming to you. So be prepared for all kind of, the best practices that you can get into your company with respect to related party transactions, because it will become wider immediately once you get listed, because the definition as per listing regulation is quite wide. Various policies, you have to be ready with all the policies, and not only with the policies, just a readiness, but implementation of the policies in your company. Then with respect to ESOPs also, your one particular thing on the ESOP scheme that the company has, immediately before listing, even the scheme has to be aligned with the SEBI regulations. It cannot remain what it was before. And then post listing, immediately that scheme needs to be ratified also by the shareholders who are at large. Otherwise, till that time, you cannot make any future grants as well. Then you will have your independent directors on board. So dealing with the independent directors and coordination with them, uh, keeping on educating the independent directors and your directors on the various regulatory point of view amendments that day in day out come into picture. And definitely regulation 30, and be very, very watchful on the UPSI, that is unpublished price sensitive information of the company. So lots of restrictions, as well as transparency that you have to get into your system. So that's the only advice and guidance I can give to everyone. And that's it. Thank you.
Thank you, Madhulika. I would like to thank Ashwini for giving us a chance to, interact with all the attendees, and also my fellow panelists, Bala sir and Madhulika, for their input. Lot of learning. Thank you to all the attendees. I mean, very interactive session, questions coming in. From my end, I would just concur with Madhulika that starting going into the process for an IPO is just the start. The main thing starts once you're listed. I would say to all the attendees that enjoy the process, because it may be only once for you, but it's very memorable. And regarding your prevention of insider trading, your ESOPs are something which, the new tech companies or the new age companies are, or majority of the companies are following nowadays. But before, it was the certificate was required from a stat auditor. Now it's required from a secretarial auditor. And once you are in the SEBI domain and, in a public domain, it's laws keep on changing every day. So you have to, continue reading, never stop learning. I think that is all from my end. Thank you so much.
Thanks a lot to everybody. Thanks a lot to the delegate. Thanks a lot to the panelists, especially my appreciation to Ashwini once again. And really, really, it's a good learning. It is really a very good experience. Those of company secretaries who are actually going to the IPO, it is a very good learning, not only in the SEBI regulation, it's a many, many fields you will actually come across. As one of our panelists points, you have to be on your toe right from the day you decide to go for IPO till it gets listed. Again, as Sujoy put it, once the listing is done, again, the game continues. That is the issue. Enjoy your profession. Thanks a lot. Nice.
Thank you.
All the participants will get the presentation, the registered mail ID, and even the recorded session will be available on the YouTube.